And boom, we are live. Okay, so covering this week's topics, I wanted to go over a couple things. So I know a lot of people missed last week's trading. I just want to go and double check just to see what we covered last week. We did fair value gaps, liquidity, and accumulation and distribution. What I am going to do is I'm just going to go over, spend 15 minutes just recapping fair value gaps, liquidity, and accumulation and distribution. Just for the guys that just want to catch up or want to get a quick refresher on that. So I am live. Everyone can see my screen. I am recording this. Yes, I am. And yeah, so let's get into it. So first thing that we're going to do and recap on is fair value gaps, right? So a fair value gap is also known as an imbalance. Okay, I'm just going to go over to the S&P 500 because this is where I do all my nonsense charting. So normally what you'll see an imbalance or fair value gap. I'm going to write it up over here. Nice and big. So fair value gap and imbalances we're going to cover now. What you're going to do is with a fair value gap and an imbalance, basically, you're going to spot them when the market makes an expansion, right? So the market can be ranging or it can be doing whatever it wants to do. And when it makes an expansion in one direction, leaving a gap between the candle before the expansion and the candle after, that's where you'll find the imbalance in the market, right? And the way imbalances are formed is when you have missed orders or unfilled orders. So commonly, that's not a spell commonly, occurs when there is an I'm going to make these orange. So commonly occurs when there's an expansion. That's the first one you got to look for. You got to look for a market expansion in one direction, right? So let me make this nice and readable for everyone. Make it 28. Yeah, there we go. So that's the first thing you're going to want to look at. It commonly occurs when there's an expansion in the market, right? The second thing that you're going to want to understand is that these fair value gaps are unfilled orders in the market, right? These orders are unfilled and they will remain unfilled until price basically goes back to that place or that area of imbalance, right? Another way that you can look at it is normally these imbalances occur when the market is manipulated or during news events, right? That's when these imbalances can occur. Okay, so let's go through to Bitcoin, and I actually want to go and show you guys this with what happened this week, basically, with all the news that came out. So if I go over to forexfactory.com, I can go and check out the news and everything like that. Sound. Do you have sound problems? Is it me? Can people even hear me? Can we just get a sound check real quick?
I'm getting every other word at the minute. Can anybody else check?
I'm good, my side.
We can hear you.
That's weird. Chaos.
It's me. I'll reboot. No worries. See you in a minute.
Cool. So news-related events that happened this week or last week, which was Monday to the 17th. Let's apply. Actually, no, it wasn't. I'm lying. It was the 20th to the 24th. No, it wasn't. I'm lying again. It was this week. So yeah, we had USD news at 3:30, which was the CPI monthly, and it was 3:30 on Tuesday. And nothing really happened much in the market over here, but I know that next day after that news pumped, this went crazy. And that was the Wednesday news. It was the core retail sales and the Empire State Manufacturing Index, right? And that caused this expansion over here, right? So that whole red box over there, that was what expansion the news caused. And the way that we spot imbalances, for example, here, right, is we look at the candle before the expansion, which is this one, and we look at the candle after the expansion, which is that one, right? And if those two candles don't meet, let me just draw this better. If those two candles don't meet, then there is an imbalance in the market, which means that these orders were not filled yet. So over here, the gap between those two candles is now going to be my fair value gap, right? And you can see it all over here. You can see that this candle over here, the wick stops at about here. The next candle then opens up top here. So there was another gap there. So we've got this fair value gap over here that we need to get filled. Price never came down to fill this gap here, right? You can spot them everywhere. Here's one. Boom. Got another one over there. And this is where it gets interesting, right? If I go to the daily, I go to that same section, the fair value gaps become bigger, right? So you see how fair value gaps are valid, but they are also time frame dependent, right? So whatever time frame you are on, the fair value gap will change because the candles will change, basically. But you got to understand that every time frame's fair value gap is valid, and every time frame's fair value gap has to still come and be filled. So it wouldn't make sense if you're trading fair value gaps in the 5 minute. For example, you're on the 5 minute looking at that exact same move, which would have been way back way here, down here. And you're over here and you're like looking at the markets like, oh my goodness, there's a fair value gap over there, and there's one over there. Well, that one got filled. There's one over here. And then you just keep marking out every fair value gap in the 5 minute. It's kind of pointless. Just go to the 1 hour and mark off the one big fair value gap. Because if I go to the 1 hour, there's going to be a bigger gap, like over here, right? We had these two zones marked off, but this gap becomes bigger when I go to the 1 hour, right? So you just got to make sure that like you use your fair value gaps properly. If you're taking a trade on the 5 minute, use the 5 minute fair value gap. If you're taking a trade on the 1 hour, use the 1 hour fair value gap, right? Base it off of whatever time frame you're taking the trade off of. Something important that you also need to understand is that let's quickly, before I go into that, let's quickly look at an example of a fair value gap that it has been mitigated properly. Let's try to find one over here. Probably be one up here somewhere. So here, right? So here, this is a good example. You can see that the market made an expansion to the upside over here, right? And it left this imbalance over here between those two candles. It left this here. There was a gap that printed between that candle and this candle. There's a small gap like that, right? I'm just going to mark it off as a FVG. There was a small gap like that, right? Then the market, what the market did was the market then came back to fill out that gap and ended up tapping into an order block at the bottom over here, right? So you see how using fair value gaps in correlation with order blocks can actually help you determine more or less where price can tap into. So for example, if I have a order block right beneath a fair value gap, which often happens, then I would set my order at the top of this order block. So I'd enter the trade over there on this 5 minute time frame, stop loss underneath the order block, and then you would basically clear the next high. So I would trade it until here to target that next high over there, right? And that would be a 1 to 4 trade, right? So how do fair value gaps work, and why do they need to be mitigated, right? So very importantly is that fair value gaps are basically orders that have been passed, right? So if the market just expands in one direction, for example, if I come over here, right, and go to the 15 minute, because it would be seen a little bit better on the 15 minute over here. Okay, we have this whole expansion up top here, right, leaving a gap between the candle after and the candle before, right? So we can mark that off as a fair value gap. There till there, and we draw it out. Then what do we see underneath this? There's an order block over here, right? So we can mark that off as well. So let me just mark this off as my FVG, and then I'll mark this order block off as well. So I'll mark this off as a demand zone, and then drag this out, right? Now, how this works and how you trade order blocks is that, not an order block, sorry, a fair value gap, is that a fair value gap is only completely mitigated once we have tapped into 80% of it, right? So you can see over here, price taps it over there, then it comes down and wicks into it over here, right? And then it goes all the way back up. Now, a lot of people would be thinking at that point, okay, cool, that was the fair value gap, we tapped into it, now I'm going to go long off of this position, stop loss underneath that wick, and boom, they get stopped out. Why did they get stopped out? Because they didn't understand that you need to wait until 80% of this fair value gap gets mitigated before you can enter that trade specifically. Or in this case, I would wait for the order block underneath it, just because it gives me a more premium area of selling. I mean, of buying, a more discounted area of buying, right? So how do I know if it's tapped into 80% of this fair value gap? Do I just look and like determine? I mean, like that's more or less 80%. No. So you'll grab your fib and you'll draw it from the top. My bad, it's not from the bottom to the top in this example. You'll draw it from the bottom to the top, and then you'll find out where 80% of this is, right? So over here, I've got the 79% over here, and I know it's just beneath that. So I know 80% of that zone will be about there. Delete it, and now I know this fair value gap needs to tap into this area to be mitigating 80%, right? And then at the same time, we did tap into this demand zone over here. So I would have taken this trade on the close of that candle outside of the demand zone. Stop loss underneath that low, targeting the most recent high, which was this one. And then you hit profit over there a couple candles later for a 7-to-1 risk to reward trade. And that would have been 2% with a 0.3% loss. If you would have done a 10x, that would have been, what, 20%? And this would have been a 3% loss. So it does work out. The maths is quite good. And that you can take any fair value gap, you can mark it off the same way, where you just want to target the 80% zone. For example, up top here, we have this fair value gap over here, right? But then we also have another one just above it, right? What do you do if you have this example, right? So what if I'm on the 15-minute and I see two of these candles printing directly after each other, like that, and they both have fair value gaps, right? You'll go to the time frame one above. So 15-minute candle, I'll go to the 30-minute time frame, right? It's one move above that. And then now those two candles get printed into one, and then you can mark this fair value gap off a bit better. And now you can have a bigger fair value gap. And once again, price then came back up into this fair value gap, completely mitigated it, and tapped into the upper supply zone over here. I took the trade at the rejection of there, and it came back up to my 50% mark, and then I took a short off of that supply zone over there, and I'm still in this trade. I'm just waiting for it to go down now. So that's how you can use fair value gaps and how you can kind of use them to your advantage, right? So fair value gaps is missed orders that need to get filled, right? So what happens is the market will expand in one direction like this, will just create a massive expansion, and then it'll come up again because it needs to come and collect those orders to like fall down again, right? So that's what it did. It came all the way back up, and that's what I waited for. I didn't enter anywhere here because this was nothing that I wanted to enter on. Waited for it to come back, entered there calmly, and then waiting for price to tap down again. So that's fair value gaps. I spent a little bit too much time on that, but just needed to get everyone's attention on it. And please define an order block. Okay, so that's one of the older lessons, but the way you can define it, kind of what you're looking for, is if you have a bearish trend, if you have a bearish expansion like this, you look for the last buying momentum, right? So over here, this would be the last buying momentum, right? So you have a bearish, bullish, bearish candle, and that bearish, bullish, bearish candle would be my order block. So that bullish candle would be the, oops, that's a fib. That bullish candle would be the order block there, right? Supply zone. And what ends up happening is, whoops, someone's busy letting me into a Zoom right now. So let me just sort that out and to Zoom real quick. I'm back. So order blocks, right? If you have a bearish expansion to the downside, right? You have a bearish, bullish, bearish candle, and that last buying pressure before the expansion to the downside is going to be your order block, right? That's how you can just kind of spot them. And you also got to understand that higher time frame order blocks are going to be more respected than lower time frame order blocks. So they can see it perfectly over here, right? If I'm on the 30-minute time frame, there is an order block over here, but there was no confirmation for me to enter that position, right? So that I would not have even kind of entered on that trade anyways, because if I go to the 1 hour, there's a upper order block up top here that I did spot and that I was busy looking at, right? So that's kind of a rough definition of it, but don't worry about that if you don't understand order blocks right now. We'll do a beginner class for you and some more people. We just want to cover liquidity, and then we can go into today's things. Liquidity I'm going to do really quickly because we don't have that much time, and I want to cover the new topics for the new guys. For last week's guys. So liquidity is basically the buildup of stop losses, right? So for example, we call this trend line liquidity over here, right? If there's a trend line, we know that there are stop losses sitting beneath that trend line, because you can then say people went long off of this. For example, they went long there, someone then went long again over here, stop loss beneath there, someone then did the same thing at the next position, went long up top over here, and you can see if, like, etc., it just keeps on going up. People keep longing off of the trend line, right? So you then know that people's stop losses are sitting underneath the trend line, and when people's stop losses get taken, a lot of money gets forced into the market, right? So that's why we see trend lines as liquidity. Trend lines to the downside, trend lines to the upside, or ranges, right? It's all liquidity. And when liquidity gets taken, you can see price falling very quickly. So for example, over here, if this liquidity gets taken, price would then fall rapidly down to the bottom of this liquidity zone. And then you can see price start reacting from there, right? So that is how we can spot liquidity. It's basically a bunch of stop losses. Anytime you see a trend line, that is basically liquidity. That's why people trade the break of a trend line, is because they think the market is going to go and take liquidity, right? So that's that. The next thing that we had to do was liquidity, trend lines. Let me double check here in the announcements. We had accumulation and distribution. So this goes along with market structure, right? When you have market structure, you got to understand that the market moves in certain ways. Let me go back to the S&P 500. And yeah, right. So the market moves in different ways. But the one way that the two ways that the market has to move is it has to accumulate before it moves, or it has to distribute before it moves, right? So for example, the market will normally enter these phases at certain areas. So for example, if the market's moving up, it'll essentially start forming an area of distribution, which is what we call a range, before falling to the downside, right? And the same way, before the market goes up, it has to enter an area of accumulation before the market shoots up again, right? And it doesn't mean that every time we enter these phases, it'll break a high or break a low. It just means that the direction is about to change. So for example, if the market moves down, we enter an area of accumulation. The market then moves up to enter an area of distribution. The market can then move down to take that low before coming up and then continuing to the downside. And on the lower time frame, you'll see it like this, where it's down, accumulate, up, distribute, down, accumulate, up, distribute, down. But on the higher time frames, it'll just look like this. It'll just look like down, up, down, right? If you go to the lower time frames, you'll spot this much more frequently. But if you go to the higher time frames, you can still see it. It just forms differently. Like, for example, if I go to Bitcoin right here, the thing that's happening on Bitcoin right now on the daily is that we are busy accumulating. A lot of people aren't actually looking at it like this, right? But you can see over here, if you look at this entire block over here, that is exactly what accumulation looks like, right? So what I drew out here last week was this was my preliminary support. We had my selling climax, which I think is going to be over here. We had an automatic rally up to the top high, and I've got a feeling we're going to come down, make a secondary test. We're going to push up, break above this automatic rally, tap into this green zone somewhere, come down to have a secondary test in phase B, and then essentially we're going to come down to have a spring around 12,000. We're going to go up and test that spring, and then I'll get my first entry, and then we'll ride it up to the upside. But this is what accumulation looks like on the higher time frames, right? You can see it's just a range, right? You can see it over here as well. This is this block up top here. This is accumulation. Sorry, this is distribution, because the market was distributing to continue to the downside. This whole block over here on the daily time frame, that was distribution as well. You can see over here, this was distribution as well. But the interesting thing about this is that if I take this, if I just draw a block around this area over here, right? This is like a great example of how how the market works. Is that on the daily time frame right now, you can see an area of distribution, right? Which is the exchange of hands, which is basically sellers coming into the market and buyers exiting their positions. Basically, the sellers are taking positions from the buyers to push the market down, right? And if you go down to the lower time frames, you'll see an area of accumulation here. You'll see an area of distribution here. You'll see an area of accumulation here. You'll see an area of distribution here, accumulation here, distribution here. So everything that you see on the higher time frames, you can see on the lower time frames, right? So this entire block over here has multiple accumulation and distribution inside of them. So that's what I mean. Like, I've been telling people for so long that time frames are fractal. Whatever happens in the higher time frames, you can see the same patterns forming out in lower time frames. So that's why it's kind of like you just need to understand how price moves on one time frame, and then you can basically understand how price moves on all time frames. It's the same thing. It just looks a little bit different, maybe moves a little bit quicker, but it's the same thing. So that's that. Right, so I spent half an hour on teaching you that. Let's get into the new topics. Let's get into the new stuff. Just had to cover that for the old guys. So,
Lyle, are you saying we're old?
no, I'm not saying anything like that. I think you are saying that yourself.
He was.
The old guy.
He was. I heard that. Sorry, I heard that.
I was just thinking, thanks, Simon. I can't mute now.
Nah, what I meant was the old guys being the guys that were here last stream. I want to cover their topics now as well. I don't want to spend too much time going over the older topics. But let's go into this week's stuff. So the first thing that we're going to cover today is correlations, right? So correlations is basically using one chart in correlation with another chart to try and see which way the market's going to go or where the market will find support, right? So at this point in time, all you have is, let me just add another Bitcoin chart on here, so that we just don't get confused. I'm going to add OKX's Bitcoin chart. So at this point in time, all we have is Bitcoin. So we have Bitcoin to decide where the support and resistance is, right? So on the daily time frame, you're gonna have to go and then mark off your support resistance, and then go to the lower time frames and then mark off your support resistance. So there are other ways of finding out where Bitcoin will find resistance, or basically other ways of trying to figure out, is this trade going to win or is this trade going to lose, right? And the two things I've found that are the most useful in this example will be the USDT dominance, right? USDT dominance and the DXY is going to be the two things that I use personally to determine where Bitcoin will find resistance or support, right? So you can see there's an inverse, wrong chart. There's an inverse correlation between USDT dominance and Bitcoin, right? So you can see this is Bitcoin. This is what it looks like. And if I go to the USDT dominance, you'll see it looks very similar, but it's just the other way around. So if I invert the scale, you'll see that that's basically almost what Bitcoin looks like on the daily. Busy tapping into resistance over here, right? Bitcoin has that same resistance level, where we have this. Let me invert it back again. Where we have this resistance over here that we're tapping into, right? So let me just make sure I'm using the right chart here. Yep, where we have this resistance over here, right? So you see how these two charts kind of correlate in certain ways, or you can use them to determine, oh, this chart is actually going to go in this direction, or as an extra confluence before taking a trade, right? So for example, this is how you'll kind of use both of those charts together, is you would come to the USDT dominance first, right? And you'll come and find out where the support is or the resistance is. Now, because there's a negative correlation, it means that if the USDT dominance goes up, Bitcoin goes down, right? So what you would do every Sunday or Monday or whenever you want to trade is you come to the USDT dominance and try and find where it will find support. So over here, right, this is where I would look at for my support area, because we have an expansion to the upside. And if I go to the lower time frames, like the 4-hour, I'll spot this a lot clearer. Okay, there it is. Okay, so we have an expansion to the upside, leaving a big gap in the market. And this doji candle right before that expansion is my demand zone that I'm going to be marking off for the support area, right? So I'm just going to mark this off as my demand zone. At the doji candle, or the last bearish candle before the expansion to the upside, is going to be my demand zone, because that's the area at which supply or demand exceeded supply. More people wanted to buy in that area before that candle, right? So let's go and drag it over to the right. So this would be my prime area for support to be found. And you can see that in this area right now, we have tapped it not only once, but twice, right? And going into a bit more advanced things, we can see that after we tapped it once, we expanded to the upside and made a high, right? So we made a chock to the upside. So we changed character to the upside in this example, and now we're coming back down to come and retest that level, right? So what would I do is I would wait for price to come into this zone over here, or even reject. If I go to the lower time frames, I'll try to find an order block even before the expansion. So here, right, this is exactly where I would take this trade off of. So I'd go to the USDT dominance, mark off an area of demand, which is the last selling pressure before the expansion to the upside, because we had another change of character over here on the lower time frames where market made a higher high. I would wait for this USDT dominance to come into this zone over here, this blue zone, and then at that exact same time, I would look for a correlating zone on Bitcoin, right? So if I go to the Bitcoin chart, that correlating zone, it's already being tapped into right now, which is this upper block up top here, right? I'm just gonna go to a different chart because I keep clicking on the same one. And that same area would be this zone up top here, right? So I can then dictate that the USDT dominance, when it taps into this area over here, Bitcoin should then be tapping into this upper zone up top here. And then I can take my order off of that, right? You could wait for a lower time for like a 3-minute change of character where you have market moving into the zone and then changing character to the downside first, where you have this, where market makes a lower low over here. Then you wait for the retracement to enter. But that's what you would do, is you would use other charts to basically determine whether or not, yes, I can short, or yes, I can long. So the USDT dominance you'd use as a normal chart, right? So if I go to the 4-hour on the USDT dominance, even the daily on the USDT dominance, you'll see over here we have a trend line, right? So we had a trend line to the upside, and then we broke this trend line to the downside. Let's go to Bitcoin and see if there was a correlation between that. Oh, wait, there was. So that trend line probably broke the same time this trend line broke. Let's check. So Monday, 9 Jan. Let's check to the USDT dominance. When did this break? This broke Wednesday, 11th of Jan, or 13th of January. It broke and closed below, right? And that was exactly when we had the expansion, that big expansion. Yeah, the 13th of January is exactly when we had this big expansion to the upside, right? So you can use these things as correlation. So if Bitcoin's busy breaking a specific zone, for example, it's breaking trend to the upside over here, and then you have the USDT dominance doing the same thing, where it's breaking trend to the downside over here, you can then use that as a confirmation of, oh wait, it is time to long, or oh, it is time to short right now. And that's how you can use it, right? So the same way you can do that is you can also use the DXY, but the DXY isn't as much of a useful tool inside of crypto as it is inside of Forex. So I would stick to the USDT dominance before you start looking at the dollar index, right? Because the dollar index is just showing you the strength of the dollar, right, in correlation to other currencies, right? Whereas the USDT dominance is showing you the strength of the dollar in correlation to how much money is going into crypto and how much money is coming out of crypto, right? Because if the USDT dominance goes down, it means that people are taking money out of USDT and putting it somewhere else, which is probably going to be a chart. Oh, not a chart, a coin, sorry. So that's why we can use the USDT dominance as a correlation to try and see which way the markets are going to go. Okay, does that make sense? I hope so. I'm not hearing any questions. Yes, okay. Pran says he likes it. Bank says yes. Okay, cool. Fire with a Z says yes. Okay, cool. Perfect. So, what I'm going to do real quick is I just need to get something. I just need to go grab me a glass of water because my throat is dry. But while I do that, just if you have any questions, think about them or just indulge in this information that I've just given you. I'm going to be back in like 2 minutes. It may be helpful to show two charts, one on top of the other. Yes, I just need to purchase TradingView Premium. I just haven't done it. I just missed Cyber Monday, and then I just didn't purchase it. And then, yeah, so that is a problem on my side. I will look at purchasing it throughout the week. Try my best to do that. So yeah, the next thing we're going to move on to. Let me just double check this. Okay, how smart money trades ranges. Okay, this is going to be an interesting one. So, whenever you see a range in the market, Terry, why are you sending me links?
You can have a look at that. I'll chat to you offline about it.
Okay, cool.
Right?
Cool. Wait, what?
Hey, don't. I'll talk to you later about it.
Okay. Damn, people send me links while I'm teaching. Okay, how smart money trades ranges, right? So the retail way of looking at this is that a lot of the time retail tells you to stay away from a range, right? Let me go back to my S&P 500. Retail often tells you to stay away from ranges. The reason because this is because you get wicked out pretty often. So when Bitcoin ranges, you'll see a lot of the time Bitcoin ranges like very vigorously, right? You get wicked out very often. So if I come into this area over here, right, I go to the 1 hour. Let's head all the way back there. And my chart loads. Yeah. Okay, so this technically was a range, right? You can have your low as kind of depends. Your range low could be somewhere here. Whoops, that is not the right thing. Range low could be somewhere here because it was the area that got tapped the most. And then your range high would be over here, which is the area that got tapped the most as well, that range there. And the thing of this is that you get wicked out. So like this would happen, this would happen, this would happen, that there were massive wick there, got this massive wicks on the left, and what ends up happening is the retail way of looking at it is you stay out of it. But if you go into depth about it, it is actually these zones or these areas where price went above the range. It's actually tapping into an area of supply on the left hand side, right? So because the smart money way of looking at it is that you don't really look at this as a trend or range, you look at it as liquidity to the upside and to the downside, right? And when smart money looks at it like when you take liquidity, you have to reverse to go and take liquidity on the other end of it. right? So if you grab that same zone, let me go to the, yeah, 1 hour is fine. If you grab that same zone up top here, right, and you wait for price to break above the range high, right, over here, we broke above the range high. You would then look to the left hand side to see where there would be an area of supply that price could reject off of, right? So if we go into here, I'm guaranteeing you that in this wick over here, there's going to be an area of supply. Whenever there's a massive wick, there's always an area of supply in that wick on the lower time frame, guaranteed. So I know that this is my area of supply, and you can see how price rejects that. How perfect is that rejection? And we close as a doji candle as well, right? Creating a second order block, right? So you're creating a second area of supply that then gets tapped into again as your confirmation over here, right? So we then tapped this area of supply with this wick over here. We closed as a doji candle, rejected it, and then came back not once, but twice. And then we sold off to the downside. So that's the retail way. Sorry, that's the smart money way of trading ranges, right? So essentially, I'm going to go back to the drawing board just to show you exactly what this method is like and what it looks like. And this can be traded on any range, on any time frame. I normally trade this on the 1 minute. Where is my range? Here it is, right? So I'm going to go here. What ends up happening is you end up looking at a chart that does this and then falls down and starts ranging, right? And what ends up happening is that price breaks the range to the upside or the downside. It doesn't really matter. In this example, it breaks to the upside, taps into an area of supply, and then goes down to take the liquidity below the range, right? So you have this, we have money sitting there, and you have money sitting there. And what's happening is that people are buying up this zone here. They're buying from here, and they're buying from here, and they're buying from here, and from here. And then people are also shorting from there, they're shorting from there, and they're shorting from there, right? So people are buying and shorting this range like crazy. So what ends up happening is that the market needs to take these guys out of the market somehow, right? The bigger guys. And how they do it is that they push the price up to take out all the sellers. It can be either way, right? Price can go down to take out all the buyers first. It's just, it'll play out the same. They would take out one direction of that liquidity, tap into an area of supply next to it, and then reverse price off of that and tap into an area beneath this, or they would continue down to take the liquidity to the downside, right? So that's how you would trade a range, is you would wait for the range to break. The reason why we do it like this and why we don't actually just short the range or like buy the range while it's in it is because it's a little bit risky, because you don't know when the liquidity will get taken, right? So for example, if I go back to my 1 hour chart over here and I go find that range again, it's up top here, yeah, and I find that same range, it's that if you bought over here, you would have TP'd up top here, yes. You couldn't buy there, you would have bought over here, but price never went back up to this area at the top, so you might have gotten stopped out with this wick over here, and then we came down, wicked beneath it again, then we went up to the top range, and then we also, if you shorted this top range, you might have gotten stopped out because this wick did go up quite high. So you have this area where price wicked and rejected the range and came back, and your traders would have gotten in there and then come down, wicked up again, taken out that liquidity above there, and then price reversed down. And yeah, so it's just a lot of stress and a lot more difficulty trying to trade a range if you just really are trying to catch the perfect top or the perfect bottom, right? You can really mitigate all of that risk just by trying to find your area of supply in that range. Should be there. Wait for that area of supply to get tapped, right? So if I go down to like the 30-minute chart, where's this range? When this loads, down to way back far, up top here. All right, if you go down to the 30-minute time frame, what ends up happening is that we created this order block over here. Did we tap it again on the 30 minute? I don't think we did on the 30 minute. No, we didn't. This zone here, we did tap into. So we then came down, tapped into that zone again, came up, came down, tapped into the zone again. This is where I would have gotten my entry. Right, so we have the last bullish pressure before the bearish down move, and this did make a lower low over here. So that would be my change of character to the downside. And then when price taps into this zone over here as my confirmation, sorry, over here as my confirmation, I would short off of that, and I would go in aggressively on this because I've had a lot of confirmations already. Stop loss above that order block. Then I would write it down to the most recent low, which would be kind of be this one. But because I know now that the liquidity got swept at the top, I can target the liquidity at the bottom. So we can target all this liquidity down here, target the bottom of the range, which would be there. And this trade is now a 57 to 1 risk to reward trade that would have cleared. Does it clear? Oh, it comes back to an upper zone up top here. Oh, we tapped into the zone again. Oh, wow. And then it clears over here. Boom. 1 to 57 our trade clears over there. And you could have gotten a chance for another entry because we tapped that zone there. Right, so I'm going to delete this again. And you can see over here, the last bullish candle before the bearish expansion to the downside. I'm going to zoom out. Price then taps into it again. Right, so we cleared this low over here, which is another confirmation. We cleared that low, making a higher time frame change of character. And then we came all the way back up to that supply zone over there, the last bullish candle before the bearish expansion. And then boom, you could have gotten a second entry there if you really wanted to, targeting the same zone down there, which would have cleared the same time. And then also the same thing happens. We have the same setup where we break character to the downside over here, and then we tapped into this last candle over there. Could have shorted that as well, shorting off there, stop loss above the high, and then riding it to the same TP. So you now have 1, 2, 3 trades running. That is got way more, whoops, that's not what I wanted. That has got way more confirmation than just trying to catch the high of the range or trying to catch the low of the range. And it does get very stressful because I used to do that. So you have this trade, which was a 1 to, I would have entered halfway into that zone. So there, 1 to 40, halfway into this zone would be literally at the top of that candle. That'll be a 1 to 22. And then halfway into this zone would be, should be a 1 to 20. So you'd have a 1 to 20, a 1 to 22, and a 1 to 40. That would have played out in the span of 9 days. 9 days, you would have made 20, 30, 40, would have made 80 RR, risk reward. You made 80 risk reward in 9 days. That is like monthly profits there, bro. Like, that is monthly profits. So that's how liquidity gets traded. That's how ranges get traded as smart money traders. You don't wait for the range to be tapping into a high and then rejecting. No. You wait for the liquidity sweep of the high or the low before you can enter the trade. Right, so I actually want to look at something just now in a second. Let's try and find it here first. Let's make sure I save this chart before I open it again with a bunch of nonsense on it. Okay. I'm just trying to find something here real quick. It was over there. Mark that a 3-minute chart. This is a live example of me trading this this range. Hold on, let me go to the 1 minute, see if I can go that far back on the 1 minute. Yes, I can. So this is a live example of me trading this during the week, right? So I had this setup that I was looking at, right? This was on US oil, right? This is for my Forex guys. I had this range low over here, right? So I had the supply zone. I mean, not supply zone, sorry, I had liquidity to the downside. Then I had the same thing where I had liquidity to the upside, right? With a deviation, liquidity up. So I don't expect you guys at this point in time to know that this is a deviation, right? The reason why it was a deviation in my eyes is because that the only zone that we could have tapped into was this one, and we never tapped into it. And as a smart money trader, you have to know that if your supply zone wasn't tapped into, it means it wasn't mitigated. Price will have to come back to it, right? So if I go to the 3-minute chart over here, I'm pretty sure I'll find that exact zone that I marked off on the 3-minute. Yeah, so it was somewhere up top here. Let me grab my fib real quick. Let me try and use that. Yeah, so I used the fib, right? And we rejected the 70.5 and the 79, right? We got a rejection in that area over there, and price came down. So price cleared the liquidity on the upside. Go back to the 1 minute because it's going to be a lot clearer. I can see price action a lot better there. Boom, 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 over here. Right? So you can see it over here. Price clears liquidity to the downside, then to the upside, and then back and clears more liquidity on the downside. So now I know, right? So now I know I have a break of structure to the upside, because market continued up. I had a break of structure to the upside, and a change of character to the downside over here, right? So now I know market wants to move down. So where did I... That's in my alert for Bitcoin. I'm going to go check it out in a second. So I know that the market cleared liquidity up and then down. So I'd wait for market to come right back up into an area of supply, and then I can short it down, right? So what I did was I drew my fib from top to bottom. In this example, we rejected that perfectly, that fib zone. I didn't take my order there because I didn't have a supply zone in here somewhere, right? My only supply zone was going to be up top here, which we hadn't yet tapped into. And I knew price had to come back to that zone. But because we made a lower low, I knew that price wasn't going to come up to make a higher high again. It wasn't going to range as like a megaphone pattern. It wasn't going to do this, where it makes progressively higher lows and lower lows at the same time. The charts hardly ever do this, right? So where you make a higher high, then you make a lower low, and you make a higher high, even higher than the previous, and that's just not the way the market moves. But what ended up happening was we came into this zone here, and then I took a short off of that, targeted this zone, was a 1 to 12, and then I ended up going for a long to target this order block up top here because I knew we had to come back and tap into it. But then I ended up taking profit a little bit early because what time was this? This was at 5 o'clock, and the market normally starts closing down at around 5 o'clock, so I took profit over there. And yeah, so that's how I traded this as my example. And that's the same way you would trade. Like that's the root of trading ranges, right? You would wait for liquidity to be cleared on one side, and then you'd wait for liquidity to be cleared on the other side, right? If liquidity gets taken one way, you target the previous way's liquidity, right? So for example, I'm going to draw that out because that sounds very confusing even in my own ears. So what you would do is if you have an accumulation range like this, you'd wait for the market to take it one way, tap into a supply zone, and then target lower target. So you'd enter from that supply zone tap over there, and you would target the bottom of that range, right? So that's what we call a liquidity sweep, right? They get the people out of the market, then they go and target the other end of the market. They get the buyers out, they target the sellers. They get the sellers out, they target the buyers, right? So that's how it kind of works. Is there any questions on that?
Can I ask a question just a little bit before?
Yeah, go for it.
On the side, remember you had that one trade where you said you had 3 going at 1, and it's a question. Generally, I've seen a lot of trades. Why don't we take profits usually, but early, and then compound those profits into? So you like had 3 trades going at the same time. Wouldn't it be good to take the profits and then then take your next bet with more compounded amounts?
Okay, so that's got to do with risk management, right? So let me look at it as like a numbers way. Okay, so if you have, I'm going to give you two answers to this because you can do it in two ways. If you have $100, right, and you enter the first trade with, let's just say, let's actually do a smaller number that I can actually divide by 3 instead of doing 3. So let's say $75, right? And you enter the first trade with $25, right? And then you enter the second trade with $25. Then you enter the third trade with $25, right? Even if the second, so let's say you enter the first trade, right? First trade's going good. Now you enter the second trade. If this second trade gets stopped out, you will not lose more money than what is in the first trade. Right. So for example, I'm just gonna go to the chart specifically, and I'm gonna draw it on the chart while I'm doing it. It was a pity that I just deleted it, but it's fine. I'll do it again. So there's two answers to this, and yes, you are right. Yes, you are making perfect sense. I'll tell you why you should and why you shouldn't, and if you are going to in the future, how you should treat it. Right, so you had one trade over here, which was up top there. Yeah, it was there. And you're targeting down there. Okay, cool. That trade was something like that. Then the second trade was when we tapped that zone again, was over there. Stop loss above the high, boom, down to the lows. And then the third trade was over here. Stop loss above the highs, trade all the way down to the lows. Okay, cool. So now you have $25 here, $25 here, and you have $25 here, right? Why? So you're saying, why don't you take profits early here and go and enter this trade with, let's say, $30?
Or also take that and go on the long up.
Go on the long up, but there's no confirmation
You
on the long.
know, but didn't you know it's going to go back up again to check your other order block?
No, that was on oil. So that was on oil, right? So this trade you're on Bitcoin, right? Market's moving down. Market's indicating to me we have to go down, but it kept coming back up. It kept expanding, leaving gaps, and coming back up to fill those gaps. So it gave us more orders, right? So for example here, right? In this here, let's do that. It's kind of how that trade looks. So in this example here, we have $25 there, $25 here, and $25 here. This trade's going good. We clear some of the profits off and we enter this trade with $30, right? The only problem, okay, then let's just say then we clear that trade off and we say, cool, we're going to enter the next trade with $40 because we just made some more profits. Right, we just made some more profits. Now we enter this trade with $40, right? The only problem with this is that if the market reverses, you're losing everything you just made. That's the only problem, is if the market decides to go above and break this order block, or come down and then come back up and break above this high, it's definitely breaking above this high and stopping this trade out and this trade out, and you just lost more money than you put in, than you just made, basically. Because if this comes down to like hit a stop loss, maybe the compounded loss on the $30 trade would have put you back at break even, if you would have done it that way, right? So the right answer of like what I would tell you to do in this example of if you wanted to take profit early, right, is I wouldn't tell you to recompound it in, even if it's on the specifically if it's on such a short time frame, right? This trade took 9 days to play out. You would have compounded over 9 days, which is a lot of money over 3 trades that you're just compounding more into it, right? For example, if you're compounding every single trade you take, eventually you lose 1 trade and you go back to break even, right? Because it took you 10 trades to make $100, but now you have $200. All you have to do is make 1 bad trade, and now all of a sudden you lost that $100 again, and then you're going to kick yourself in the face. So what you would do in this example, what I normally do, all right, is I have a set amount of risk that I take per trade. So every trade I take, I risk between, come up here, between $25 to $50 risk per trade, right? And the way I TP is that as soon as we break one of the lows, I'll take 50% of the trade. So there, I'll take 50% off this trade over here. But when I re-enter the trade again, I'm not risking more. I'm still risking the same amount, $25 to $50, right? And if I work it out, how much RR is this? This is 9, right? So if I had $25 risk there, then I would basically have just pulled off, there would have been 225, and I would have pulled off $112, right? So I would have TP'd over here half of this order for $112, right? Then I'm risking, so now I know I've got $112 in the bank, right? So now that's clear, that's in my portfolio. Now I go back and I want to enter this trade again, right? I'm still risking the same amount. I'm still risking $25 to $50. I'm not going to risk more because that's not my trading plan, right? So I'm risking $25 to $50 over here. Most likely if I'm risking 25 in the first one, I'm risking 25 again. So let's just say I'm risking 25 again, right? So if we do hit stop loss over here, I'm only losing, I'm losing about, how much would this be? I don't know how much that would be. I can't work that out. My brain's not working right now. But basically what I'm saying is I wouldn't lose more than $112. Whereas if I entered this trade with a compound, I would have entered this trade with a higher risk. This risk would have been probably, with that amount, the risk would have been $50 to $75. So I would have risked $50 to $75. Now this trade doesn't go my way and it hits stop loss over there. Now I'm at break even over here as well because it also stopped me out over here. And then I just lost half of what I just made. So now at the end of the day, you're risking too much and you could have walked away with $112 where with a loss of 25, but now you're walking away with $112 with a loss of 50. So in the first example, you're walking away with $100. In the second example where you're over risking, you're walking away with $50. So it's all about risk management. You can't just compound every single trade you take. You need to set targets for yourself. So what I normally tell people is if you have I'm going to use a $400 account. If you have a $400 account, right? The correct way to do it is not to recompound every single trade because you lose one and you're then screwed. The right way to do it is to set yourself a target and say, when I get to 600, let's say it's $600. When my account gets to $600, I'm going to risk a little bit more, right? Or I'm going to increase my leverage a little bit or whatever, right? But the main goal is that, let's say you want to risk 10% of your account, right? You would still risk the same amount if your money goes up, if you're working in percentages, but the money would increase, right? So let's say you want to say, cool, what's 10% of 40? So, which is going to be $40. 10% of 400 is $40. You're risking that in money. Now all of a sudden, when you get to $600, you want to say, cool, I'm going to increase that to 60, right? Then you set targets. So between 400 to 600, you would risk $40 on every trade. Every trade you take, $40, $40, $40, $40. That's the risk. That's risk. That's risk. Then when you get to 600, that's when you say, okay, cool, I want to increase my risk now because I'm on 600. Now you say, cool, $60, $60, $60, $60. Then maybe your next target is 1,000. Whatever target's reasonable for you. So now your next target's 1,000. So now I say, cool, I'm going to risk 10% now again. So now you say, cool, now I'm risking $100 on a trade. So I've got $100, $100, $100, $100. Then your next target, what's the next target? 2,000. Or, yeah, 2,000. Because you need to make one 10-hour trade and you get that in one day. Or you need to make 2 5-hour trades, 5 risk reward trades. Then you can get that in one day. So the thing is, you don't compound up, is you set targets for yourself. And once your target gets reached, you then adjust your risk according to that target. Right? Because it's pointless, every single trade you take, you're risking a little bit more. Because you're going to lose a little bit more every single time. Because it's the same way as if you have you can never have a 100% winning strategy. Right? That's impossible to do. But at the end of the day, if you have a 70% winning strategy, even a 50% winning strategy. No, let's even go down lower. Let's do a 30% winning strategy. You win 30% of your trades. But every trade you take is a 1 to 5R trade, right? You're still making money in the long run. But this is where it gets a bit tricky. So you go, let's say trade 1 was a win, trade 2 was a win. Now trade 3 was a loss, right? But because you compounded, this loss that you just made took away all of this profits that you just got, because you compounded those profits into this loss. You now lost all of the profits you made. So now you're back at square one. Instead of then taking the loss, and instead of setting you back to square one, it would just set you back one more trade loss. Like, you would still be in profit from 2 wins ago. You know what I mean? So does that make sense, Schnab?
Thank you. Yeah, that's cleared that up.
Cool.
Cheers.
Yeah. So like a lot of people get so confused with that point of I have to flip my account. I have to flip my account. Or oh no, like this person did it in like 6 months. That means I can do it in 6 months. Yeah. No. Like those people that you see on YouTube where they go $500 into $1 million and they do it in like 3 months, they are over leveraging their account. They're like going in with like 100x trades. They are spending way too much time over leveraging on a strategy that they know how to trade. And the reason why they can do that is because they're trying to sell you courses, 1. 2 is because they know how to trade so well that they can read price action and they can know exactly when price is not going to go their way. So they can over leverage because they won't end up losing all of their money because they know how to trade. But the problem comes in when you try to do that same thing where you like over leverage, or you compound your trades up, and then all of a sudden you lose one and you then set yourself back 50% of the way, and then you're like, oh no, trading is not for me. Oh no, the strategy doesn't work. Oh no, this person lied to me. I just lost half my account. But it's like, no, dude, you just over risked your entire position to make more money because you're greedy. And that's the thing, is like the universe works that way, is that if you're greedy, the universe takes it back from you. Guaranteed. So yeah, that's kind of an important thing you've got to understand. I'm just gonna wait here and just check. Don't forget to check your alerts with us, please. Oh yeah, shit, I need to do that. I'm in a short position right now. I'm pretty sure that I just got stopped.
Sorry?
Look at that, bro. That's perfect. So I don't like this because we just made another higher high over here. But we'll see how this next candle closes. Let me just quickly check on my phone to see if I am still in this position, or if it did stop me out on my... It's not loading. I should still be in the position. Unless I moved my stop loss to break even, I should still be in this position. But I'm not sure if I moved it to break even. I'll find out. I'm not upset if I get stop to break even because I don't lose anything. But yeah, but it's in a tricky position right now, which I'm going to go over in about an hour from now in the market weekly breakdown. I did post the notification in the, if you go to the announcement section of the Discord, the most recent announcement, you see, it'll say their market weekly breakdown, 4:30 GMT. That is 6:30 South African time. We're going to be going over a couple things on crypto as well. But yeah, look, to be honest with you, right now, with Bitcoin, I'm like 50-50. It's because we are rejecting this high over here, which has been rejected there. But at the same time, Bitcoin's been doing these massive legs to the upside. And at any point, we could just leg up, retest, and then leg to $30,000. And at that point, I'd be looking for more shorts at 30,000. Because you can see up top here, we have the last bearish candle before the last bullish candle before the bearish down move, and that's sitting at about 30,000 to 31,000 roughly. That's my next selling zone. So yeah, but at the same time, I don't think that we can break above it and close above it and then go to 30 right now. I feel like that might come later. I feel like they're just getting because like all of this week was all news related events, and I've got a feeling we might just pop and then wick down and then just slam to the downside. But we'll see, because I don't trust any of this nonsense over here. These massive legs up because of news. The reason for that is because the dollar has been going down, but Bitcoin has been going... Sorry, no, the dollar's been going up this week. So you can see over here, this week the dollar's been moving to the upside, right? And Bitcoin's been moving down, up as well, which is not what it's supposed to do. If the dollar goes up, Bitcoin's supposed to move up, move down. Sorry, there's a negative correlation. So dollar up, Bitcoin down, dollar up, Bitcoin down, dollar up, Bitcoin down. And the dollar's been moving up this week, but Bitcoin's been moving up as well, which is a weird sign for me. Normally the Bitcoin doesn't follow the dollar. So I'm very interested to see how this plays out. Also, we have liquidity to the downside here, which we haven't cleared yet. But it also looks like we're rejecting that trend line at the same time. So that trend line that we have created over here, it looks like price broke beneath it over there and then came back up to test the trend line. And is now might drop. But we'll see. We'll see. Very interested to see how it plays out. Because this is my first bear market in crypto. So I want to know how this price reacts. First time I'm seeing price react this way. But are there any more questions? That's what I can take. In the same trade, hit the OB. RSIs are pretty high on multiple time frames. Yeah, dude, like... Yeah, this is a different RSI. This is the normal RSI. I know the stochastic's probably sitting like right at the top. I actually want to see this in the lower time frames. See what this looks like. Yeah. Whose mic is on? Pajama Donkey. I'm just gonna mute you real quick. I'm gonna serve and mute you for now. Yeah, look. Gotta reject this. Let's actually watch it, yeah. I'm actually gonna watch it here for a second. This lesson's basically over. Because I've covered all the topics I needed to cover. That's what I'm saying. If there's questions or discussions you guys want to go over, just speak to me now. Because I'm probably going to get some food after this and then go to the crypto banter weekly analysis. Yeah, I got stopped out of that position. I was at break even for this trade. And then got stopped out. What's ETH doing? Oh, ETH did the same thing. That means this trade also stopped out. Yeah, break even on both of these. Wow. Wait, this is another example. This is another example of me. Like, I could have taken multiple trades here. So we tapped into that zone there, and that's where I got my initial entry, targeting the pretty recent low. Right, price came halfway through, but didn't actually clear all of it. And then we came back up to this zone here, which I could have taken another entry off of, but I didn't. And then stop loss would have been at the same point as that. Now it would have been here somewhere. And then price then made a lower low and tapped into this zone. Could have taken an entry there if I wanted to, because that would have been another order block there. And do you see how all of these would have gone wrong by one wick over there? So yeah, that's why you don't over risk or over leverage your account. Don't put too much money in. So, like, take one trade, risk one amount. But also, if you're trading multiple trades, you got to be putting your stop loss to break even very quickly. So that's like another thing that I also do, is I put stop loss to break even very quickly. And I think Renando was trading with me this week, and literally if we clear a 1 minute low, I'm like, break even right now, let's go. Risk free trade. That's why I get stopped out at break even a lot. I get stopped out at break even. When I say a lot, I mean like I'll get stopped out like 4 times before I win a trade at break even, before I like win a proper trade. and it happened to me on Friday. Friday, I think I got 4 break evens, no, 4 or 5 break evens, and 1 loss, and then I got my 1 to 5 hour trade. And yeah, so for this example here, we cleared this low. See how this price then came down and cleared beneath this low? That's where I set my stop loss to break even. On this trade here, when price cleared beneath this low over here, I would have set my stop loss to break even. And on this trade here, even price cleared this low over here, which it never did, I would have set my stop loss to break even. So this trade would have been a loss. This would have been break even. This is break even. This got stopped at break even. So this would have been 1 loss and 2 break evens versus just 1 trade at break even. So yeah, if you're taking multiple entries, you got to set multiple break evens at very quick intervals, because you don't want to get stopped out on like 4 different trades at break even. And I want to check this out. 1 minute time frame. So yeah, that's that. Let me check the chat real quick.
I have another quick question on that. I see on your fib you've got percentages on there. How did you set that up? Because on my fib I don't have those.
Yeah, I know. You literally have to come down to the bottom and say levels, and then you just make it percent and not value.
Okay, perfect.
Honestly, it really doesn't matter. I just prefer the percentages instead of the values. Like 0.705 versus 70.5. But yeah, just come down to levels percent.
Cool. Thanks.
Cool. Sure, see how this plays out. I'm going to stop this recording as well.